Hi, I'm Lynn Adams.
I'm Justin Gross.
Thank you for joining us for this edition of Video Insight. This is our fourth quarter client conference call. We're going to take you through some things today, kind of give you an update of what's going on in the market and some of the investment strategies that we're working with, and I hope you can find this useful. Just as an important note, everything we talk about today is for educational purposes only. There's no intended investment advice here. Just want to give everyone some general ideas to help them understand what they see on the TV and what their statements are and all that kind of stuff, putting the pieces together. So with that, we'll get started. Year to date, through the end of third quarter, market's up pretty good, but it's very split. So the stocks in the U.S. have had a really good run this year through the end of September, and everything other than U.S. stocks has been negative, right? And I think that kind of plays to two different types of clientele. You know, if you're younger and you're more aggressive, you have more stock exposure, you see this as a pretty decent year. If you're older, have a lot more fixed income, have more bond exposure, then you've lost money this year, right? And then, of course, most everybody fits in between, because most of the time you're diversified. You'd have some stocks and some bonds, and so just depending on how aggressive versus how conservative your target is would determine this year what your outcome would be. And
it's regionalized. U.S. stocks have done well.
That's right.
International stocks are negative. So when you look globally across asset classes, U.S. stocks continues a run that they've had for quite a while of being the bright star, and everything else is not.
That's right. And interestingly, if you're trying to be conservative and you're owning fixed income, bonds, treasuries, things like that, you're actually negative because interest rates have been rising, and if you own bonds while interest rates are rising, it tends to not be a good formula.
And the human psyche starts to say, well, I want what's working. Right. So let's go get some stocks. But you have to be true to your individual risk tolerance and not chase.
Right.
You can't chase.
Very, very valuable point. Actually, a great segue to the next slide. We want to talk a little bit about, since the last market bottom back in 2009, if you had just owned the most aggressive stock pieces and that's it, today you're up 500%, right, since that point in time. Now, obviously, no one that we know owns just that, because you try to be diversified and a lot of people can't take that kind of risk. But, are we near a high again, right? Or is this a good time to invest in stocks? That's the questions that we get. So I put this slide here in the slide deck to kind of show that, it is important to realize that even if you had bought at the bottom of the market back in 2009 versus if you had had terrible luck and bought just before the market started going down, like at the previous peak back in 2007, right. If you just held on to those core stocks and you didn't trade them away, you still would have made money. From the top of the prior market to now, you're still up 150%, versus buying at the bottom of the last market trough being up 400 or 500%. Now, there's a big difference between being up 100% versus 500%, which annualizes maybe being up 6% versus being up 12% for all those years. But the singular biggest difference is, I think, is about having dry powder when the market is in trouble.
Yeah, having dry powder or having some rules-based strategy to be able to try to get out of the way, right?
Right. So it's not about winning because you're outperforming as it's going up. It's about recognizing that when it goes down a lot, which it does every so often, having cash available that you can invest at that point is really a bigger decision to get right than whether you bought large cap or mid cap or small cap or this fund or that ETF. It's about understanding the long-term cycle. We think that this plays into our strategy with the defined risk strategy, in that, if the market goes below its 200-day moving average by a certain measure, we would take out money, leave it in cash or short-term bonds, and let the market go down as far as it needs to get back to a normalization, and then we would re-enter. Not because we think it's time to, but it's mathematically proven. The 200-day moving average is a great barometer.
Yeah, I think it's mostly about having a plan of attack before it happens, not trying to formulate one in the midst of it happening, because your heart and your head will lead you wrong. Yeah. In the middle of the storm, you're going to want to get rid of what's losing money, and that's the wrong time. So
and that's what people have done over and over again for decades, right? So one of the things that we do think about in terms of, okay, well, what's going to be the reason for the next big pullback, the next recession or worse? And every day you can turn on the TV, and these are some of the topics that you hear. You know, the trade war. You hear about rising interest rates, the political tensions. You know, what's our president going to tweet tomorrow? You know, that kind of thing. Another one I hear a lot of is student loan debt. Right? A lot of people say, well, you know, all the young people have all this debt, and so there's this notion of the market tends to climb a wall of worry. Right? It's going up despite all of these things, but any of those things could, become a larger issue. It could explode into a more larger problem.
Right.
So I thought we'd just walk you through a few of these things to help you kind of see how they're connected. Let's start with the trade war, right? Which, interestingly, the trade war is a media term. That is not the term that, you know, the politicians would speak to the people they're having the discussions with. But as we create an environment where the U.S. is making more goods and services by creating incentives through tariffs to not buy those goods and services overseas, then our population gets more work, more jobs are created. As those jobs are created, then the next thing that tends to occur is that people have more money to spend and the economy speeds up, right? So these are things that is the intended outcome of making a larger incentive for people to buy U.S. goods versus buy things from abroad or China or whatnot. And it's actually working, right? Here's a slide to show you. So look at the percentage of our population that is working as all people. So this is a chart that shows that currently 62.7% of our population is actually working, okay? Now, 3 years ago, that was actually a lower number, right? And so there's been, for about 9 years, this segment of our population that didn't have to work. They could just live on a lower standard of living, maybe collect Social Security early, but it wasn't worth their effort to go work because wages weren't high enough. And so now that we're seeing more and more American companies looking to manufacture products here, and there's a demand for workers and wages are rising, you're seeing that that other category is shrinking significantly, right? So that's a piece of the trade war discussion, is that we're really trying to create more work, more people working in the U.S., right? Another way you can look at it is with the unemployment data, right? So we're now down into the upper threes as percentage of people, 3%, people can't find work that are looking for work. That's a 50-plus year low. So this effort to bring more jobs to the U.S. by taxing companies that don't want to have jobs in the U.S., they want to make stuff overseas, it's having a pretty significant impact on the labor force.
Yeah, you're not going to hear that on the headline. That doesn't make headlines.
No.
It's about what are the intended consequences a couple layers or steps down,
right,
that
or let's try to find an industry that's being hurt by it, right? I saw an article on TV about the big shipping companies that used to do a lot more shipping overseas are really hurting. They've lost 400 jobs this year, right? But they don't tell you, well, this year we've also created 400,000 new jobs, you know, because more American workers are being put to work.
And in the micro level, there will be winners and losers.
Right.
But this is a broader scale topic here, so it has some very specific consequences and intended targets.
The implications are greater than just stocks. I mean, obviously, if we have American companies making American products, selling more goods and services, there's more profits. That's easy to understand. But there's also implications to our government deficit, right? So here's a slide of how the government deficit is structured, how much we spend, how much we bring in, right? Let me just point out a few little areas to help those that can follow this a little bit. If you go to work and you haven't been working, well, now you are actually paying into the Social Security system, right? So rather than maybe if you're 62 to 66 years old and you've been taking early Social Security, maybe you set that down and go take a job. Well, now instead of taking, you're putting it in. So this is a positive for the budget when you have more people paying into Social Security. Obviously, if you're working, you're also going to pay more in taxes, right? So the actual tax revenue for the government is a higher number. That's a secondary result that's positive. The third thing is these companies are selling more goods and services, so they're paying corporate taxes. They're paying more taxes because they're more profitable. And lastly, on the government income side, you and I, we own these companies as investments. When we sell one and we make a capital gain, we actually pay higher capital gains because we now have more profits. So every piece of the actual government income part of the balance sheet is affected in a positive way because people are going back to work, right? What about expenditures? So on the expense side, well, if you're 62 to 66 and you decide that I'm going to take that early Social Security and put it on hold and go take a job that's going to pay you, $1,000 a week or something that you could go and do, well, that Social Security money now they're not having to pay you till you get to full Social Security. So that helps them on expenses. Another issue is like the super low income, the people that have like been on Medicaid benefits and just really struggling. Now if they get jobs, there's less Medicaid going out. So the expenditures for Medicaid is lower. So there's a lot of pieces to that aren't just jobs, aren't just profits, but it's strengthening our actual balance sheet as a nation.
Yeah, and I think that's the point, and I feel like that's partly our job to explain that because it's bigger than let's just pick a fight.
It is. Or which stock is going to win or which stock is going to lose over it, right? Okay, so that being said, the other thing that's been happening that's really not talked about, doesn't make good news, is the condition of the American consumer has really improved. If you look at household net worth, it's the highest dollar value of the American citizen's individual net worth we've ever seen in recorded history. While at the same time, the debt that each individual household is carrying right now is less than 10% of their income. That is also like a 60-year low for how much individual debt we have relative to what we earn. From a fiscal health standpoint, in my career, which next year is 25 years, it's never been this good. So I'm not trying to sound like we're in a Goldilocks environment where everybody's going to make lots of money for an extended period of time, but it is important to realize that because these financial conditions exist where we have an improving federal government budget, we have an improving consumer, we have improving jobs, these all stabilize the market and the economy, which gives us the base that we can see companies' earnings growing from. Interest rates, short and sweet as they go up. If you own bonds that are impacted by interest rates, you own one at 6, the new ones come out at 7. You own one at 2, new ones come out at 3. You're going to lose money because you don't have as good a yield as a new one. But as interest rates begin to taper and get to more of a levelized position, I think that the higher interest rates will actually help. There's some sectors it's helping now. Banks, it helps. The insurance companies, it helps. But right now, it is a drag on leverage, right?
Yeah, and we've been expecting this for a long time, years ago even. You don't know what's going to propel the rates forward, but keeping duration short, diversifying globally, even using some product. It's some things that we could do to help offset interest rate risk. And I think for the conservative client and investor, getting those higher rates, just getting through this period of time on the other side is nice.
Yeah, we've probably done more fixed 5-year structured contracts, or 7-year fixed interest rate things in the last 2 or 3 years than we've ever done, because we just want to get you to a place where the interest that you can get in the future now is really attractive, but you don't want to own
just
fixed
bridging
income
that
while
gap.
Rates are going up at this rate, okay? But it can have shocks on the market because remember, companies borrow to invest. Correct. They borrow to grow. So as interest rates go up, they'll cut back on their spending, and that can actually create forecasts that the economy is slowing. But I think it tends to be very short term. Every quarter or two you might get a blip because interest rates went up quicker than anticipated for stocks. Student loans, you hear a lot about student loans. I remember graduating and having a lot of student loan debt, and I remember thinking, man, if I'm ever going to get out of this thing, it'll be great. I have a mixed view on student loans. I think that it's tough for you to see spending happen when people are strapped with student loans, but at the same time, I think it is a high motivator to get people to work. Like young people coming out of college and they've got student loans, like they cannot not work. And again, I'm beginning to believe more in the camp that the Trumponomics philosophy of if you create wage inflation and you create the demand for workers and everybody gets paid more at the entry level, that's a really healthy thing for our economy. That I think the student loan situation actually provides a catalyst for young people to work to the same degree that it hurts people that have student loans from spending more money. I think they negate each other.
Right.
So I wouldn't worry too much about the student loan front. Looking forward, we just wanted to kind of throw out a few things to think about on the stock side of things, okay? For several years, we have been concerned that there's not a lot of catalyst for this market to grow between now and about the year 2023, 2024, when the millennials get to what's called peak earning, when the leading edge of the millennial population, which is the largest population in our history, when they get to their mid-40s and late 40s, they'll enter, we believe, what's called peak earning years, and they'll spend more than probably any generation ever has been able to. But before we get there, which is between now and 2023, there's not a lot of reasons to expect growth. I think that this trade policy, this increasing jobs at the lower end of the spectrum policy, if it works and it continues to work like it has in the last 2 years, say for the next 3, I think we might have bought ourselves a bridge to the point in time where the millennial generation can really carry the economy from that point. So I don't necessarily believe at this moment that we have to have a major pullback or a major recession because the market's gotten ahead of itself. Whereas if you'd have asked me 18 months ago or 2 years ago, I would have thought, I'm not sure how we're going to create growth. So I think that this could go on for a while if this policy remains effective, right? But in any environment, you have to be aware that the higher prices go, the more risk is in the trade, right? So if the Dow were to go to 40,000 in the next 3 years, right? Well, because it's higher, it could lose more, right? If we get a slowdown or a disruption. So you have to, as Justin said earlier, you have to have a plan of how you're going to play defense before you're getting, punched in the face with things going down, right?
I can't believe this is the first time in forever we haven't had the slide of the average decline in a year, but that's the nature of the market.
Right.
We saw it earlier this year, January and February. That's markets. They can get too high, and they have a way of selling off quickly. That can happen, but
right.
Having the defined risk strategy underneath that is a powerful thing because it's being able to capitalize on the growth that we've already seen. It's been long in duration, hasn't necessarily been explosive to the point of a bubble. It doesn't
right.
feel bubble from the economic
right.
standpoint, but having any drawdown to be able to protect against that is powerful.
In fact, on that, the price to earnings ratio as of the end of the third quarter for S&P 500 was still in the 16s. So from an actual earnings valuation standpoint, we're not excessive, but the price tag is high because earnings are high.
Right.
So having that strategy in place is probably important. You don't have to use our strategy. We like our strategy. We put a lot of energy into making it what we believe to be one of the best ways to manage risk for low cost, but you need a strategy for what are you going to do if the market begins to move in the other direction. And you don't want to be the investor that gets your 401k statement and it says, okay, I own some bonds, I own some stocks, some are U.S., some international, and you say, wow, I like the fact that my U.S. stocks are up 10% in the last year and everything else is negative. Let me just move everything that's negative to what just made money. Because if you do that, you're buying things at a high price and you're selling things at a low price, and that's not how you make money. It's not how it works, right? So to conclude, wrap up our call, I think that there's always surprises. And lately, the surprises have been to the upside with higher earnings in the U.S. than were previously imagined, yep. right? So, I'm going to go out on a limb here and say that I think that those surprises can actually continue if this policy directive stays in this direction, right? And you know what? Sorry to regress here, but we don't even actually have to have the tariffs to get companies motivated to put more plants and manufacturing here. It's the talk of tariffs, right? If I'm getting ready to build a new manufacturing facility and I'm thinking about doing it in Mexico, but I hear all this talk of tariffs, I'm probably just going to play it safe and invest here rather than build it elsewhere and then
Right.
take the chance that now I got to pay all these tariffs, right? Just the discussion of tariffs alone is a big motivator. So if this policy stays in this direction, I think that's going to be good for the economy, good for jobs. It could be a sustainable path to get us until the millennials are really contributing at their full capacity. And then last thing to say, again, I can't say it enough, is you just have to have a plan for what are you going to do when things deteriorate. And the old saying is, you never got hit by the train you saw coming, right? We don't know what's lurking in the weeds or in the dark or in the shadows, but you know, every 5, 10, 15 years you get something and you got to be prepared. So we're cautiously optimistic, and we like stocks, but we also are hedged in almost every stock position that we have.
Yeah. I'll figure it out when it's happening is not the right strategy.
It is not. So hopefully that gives you a good overview where we're at in the markets. If you have individual questions, please reach out to us or your advisor here, or if you're not one of our clients and you happen to see this, feel free to email us. We'll respond to anyone. We appreciate the opportunity to serve you and your families. We take it very serious, and we want to do a great job for you, and it's important to us. So with that, I'm going to wrap it up, and Justin will run us through the required disclosures.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
All economic and performance information is historical and should not be considered indicative of future results. Investments in securities do not offer a fixed rate of return. Principal yield and/or share prices will fluctuate with changes in market conditions, and when sold or redeemed, you may receive more or less than originally invested. These views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Consult your financial advisor for more information.